we look at the CME FedWatch tool sometimes. I'm not sure if that's something you look at as well. Right now, I'm seeing about a 84%, 85% chance of a cut coming up in September. Up big over a month ago. A month ago was about 55%. Do you agree with that directionally, that the odds are actually increasing despite PPI being hotter than expected and CPI honestly being mixed? I've said it a bunch of times on this show. Headline was better, but core was a bit hot.
Yeah, directionally, I think that's right. I think there's a high probability that we get a cut in September, probably another cut in December, so 2 cuts to end out the year.
What do you make of that rebound in healthcare? We just touched on it a minute ago. A lot of it's spurred by big-name investors investing in names like United Health. Just to give the audience just a quick refresher, we're talking Berkshire, Appaloosa. Also, Michael Burry, who was shorting the stock, decided to buy into the stock. Do you see this as potentially a bottom when it comes to healthcare? And we just also mentioned healthcare is the best-performing sector this month.
Yeah, obviously healthcare was quite oversold, so it was due for a bounce. We're expecting better news out of the healthcare sector going forward. So I think it's just a matter of it being oversold, people looking at the longer-term opportunity for some of those big cap names.
I mean, but how long is this longer-term opportunity? A bounce is one thing, change in direction is a different thing. So do you see it as a bounce or a significant change in direction, a bounce off the bottom where it moves higher from here?
Yeah, from this point forward, we're going to need to see some better earnings growth out of these companies. We're going to see some stabilization in United Health, and we're going to need to see visibility to stronger earnings growth going forward without nearly as much of an overhang from some of the policy and other factors. All right,
I want to talk to some areas of the market that you're looking at. Now, this is kind of an area where we're seeing policy and the markets kind of intersect. You're looking at prison stocks. We're going to show a couple of them. I got to look, though. When I look, though, they're actually down over the last 3 months, despite some of the moves that we've seen from the administration in D.C. and other areas. Those stocks have traded down after a big run-up, in all fairness. Year to date, they're outperforming. But after a big run-up, why is right now a good time to buy into those stocks?
Well, there's been a lot of money that's been allocated in the big, beautiful bill to Homeland Security. And we expect those funds to start being dispersed in the coming weeks and months. And a lot of those will go to detaining immigrants, and that will lead to higher bed use and higher demand for the prison companies.
All right, we're showing 2 of them. One's Geo Group. That's the name we've talked about quite a bit here on CNBC. The other one's Core Civic. So you're seeing that policy leading to a rebound in the stocks, because right now we're showing it year to date. Geo Group's actually down 25%, despite all the talk about detaining people and some of the other law enforcement measures the administration's taken.
Yeah, that's right. I mean, Geo's been harder hit than Core Civic because of its monitoring business, which has really been stalled. So we need to see a rebound in that monitoring business for that stock to really work. Our preferred name is Core Civic.
All right. I want to go to another part of the market you're looking at, which is the AI trade, but indirectly. You're not necessarily talking about the Mag 7. You're talking about Uber. And you're actually concerned about Uber's business long term. You say about 40% of their mobility gross bookings are at risk with autonomous driving. I always thought Uber was an autonomous driving play. So why would the rise of autonomous driving hurt this name?
Yeah, autonomous driving is likely going to be the future, and that's not great for Uber, because when we look at that market, it's all about concentration of supply. If there's a concentration of supply, the pricing and the power goes to those suppliers. Think about the hotel versus the airline industry when it comes to online bookings. In the hotel industry, the hotels do not make much money. The OTAs do, the platforms, because it's so fragmented. Whereas the airlines, they actually get most of the profit, and the platforms do not. So in this case, because there's a concentration of supply in autonomous vehicles led by the likes of Tesla and others, we're likely to see the profit pool go in that direction and not to the platforms like Uber.
I don't think this thesis from you is music to a lot of people's ears, because last week we saw the market kind of broaden out. People seem to want to move past the Mag 7 and just the kind of concentration of the major indexes. But it sounds like you're saying those Mag 7 names and those more broader AI plays, that's really where you want to be, and not names like Uber, more not on the fringe, but a secondary beneficiary.
Yeah, that's exactly right. We're looking for the AI team to broaden out, but Uber is not a name we'd play there. There are other names that we definitely play as second and third derivatives on the AI theme.